The role of cryptocurrency in emerging markets, opportunities and risks. Cryptocurrencies are emerging as a beacon of change in the swiftly evolving world of finance, particularly in emerging markets where traditional financial systems frequently fail. By providing innovative solutions to financial inclusion, transactional efficiency, and economic instability, these digital assets, which are powered by blockchain technology, have the potential to revolutionize the economic landscape. Cryptocurrencies provide a means of economic participation that was previously unattainable for numerous individuals and enterprises in developing regions. Millions are presented with a tantalizing opportunity to safeguard assets from inflationary pressures, access financial services without a bank account, and conduct cross-border transactions with minimal fees. However, the emergence of cryptocurrencies in emerging markets is not without its obstacles, as is the case with any transformative technology. Significant risks are posed by the volatile character of digital currencies, as well as regulatory uncertainties and security concerns. The crypto landscape's complexity and the rapid rate of adoption have resulted in a high-stakes environment that amplifies both opportunities and risks. The potential for cryptocurrencies to fuel economic growth must be balanced against the risks of instability and fraud as emerging economies navigate this digital revolution. The function of cryptocurrency in emerging markets is a compelling and critical topic for analysis due to the duality of opportunity and risk. 1. Financial inclusion and accessibility. Enhanced financial inclusion is one of the most compelling opportunities that cryptocurrencies offer in emerging markets. Large populations in numerous developing countries remain unbanked or underbanked, as they lack access to conventional financial services. Cryptocurrencies, by their very nature, can offer an alternative method of participating in the financial system that does not necessitate access to a traditional bank account or physical infrastructure. For example, in areas such as sub-Saharan Africa, where financial exclusion is widespread, cryptocurrencies can provide a lifeline. Mobile money services such as M-Pesa have already illustrated the potential of digital financial services to address financial access disparities in countries like Kenya. Cryptocurrencies expand upon this by providing additional inclusivity. Individuals can access credit, conduct transactions, and store value with only a smartphone and an internet connection. This can be particularly beneficial for individuals residing in remote or underserved regions, as it can stimulate economic activity and promote greater financial independence. 2. Protect against inflation. The value of local currencies and the purchasing power of individuals can be diminished as a result of the high inflation rates that frequently affect emerging markets. In these types of environments, cryptocurrencies may serve as an inflation hedge. Digital assets, such as Bitcoin, are perceived as a reserve of value that is less susceptible to the fluctuations of local monetary policy due to their limited supply. I will use Venezuela as an example. One of the most severe instances of hyperinflation in recent history has occurred in the country. Many Venezuelans have resorted to Bitcoin and other cryptocurrencies as a means of safeguarding their wealth in response. This change enables individuals to safeguard their savings from economic instability and rapid devaluation. In hyperinflationary environments, individuals can preserve their purchasing power and attain a degree of financial security by converting their local currency into a digital asset with a more consistent value. 3. Remittances and cross-border transactions. Cryptocurrencies have the potential to revolutionize the field of cross-border transactions and remittances, which are essential for numerous emergent markets. High fees and extended processing periods are frequently associated with conventional remittance services, which can be taxing for both senders and recipients. These costs can be substantially reduced by cryptocurrencies, which facilitate quicker and more cost-effective transfers. Cryptocurrencies present a promising alternative in countries such as the Philippines and India, where remittances are a significant economic factor. As an illustration, platforms such as Stellar XLM and Ripple XRP are intended to expedite settlement times and minimize fees for cross-border transactions. Traditional intermediaries are bypassed by cryptocurrencies, which facilitate near-instantaneous transfers by utilizing blockchain technology. This can be especially advantageous for families and individuals who depend on remittances to sustain their livelihoods, as it alleviates the financial burden associated with conventional remittance services. 4. Innovation and economic development. Economic development and innovation in emergent markets may be stimulated by the expansion of the cryptocurrency sector. The crypto industry's expansion creates new career opportunities and spurs technological advancement. Local startups and blockchain initiatives have the potential to stimulate economic activity, thereby promoting entrepreneurial ventures and creating employment. Local cryptocurrency and blockchain ventures are already having an impact in countries such as South Africa and Brazil. These firms are creating innovative solutions in sectors including agriculture, fintech, and supply chain management. For instance, blockchain-based solutions can improve traceability and reduce fraud in agricultural supply chains. thereby increasing transparency and efficiency. This form of innovation has the potential to enhance the integration of emerging markets into the global economy and contribute to the overall development of the economy. 5. Security and regulatory risks. The adoption of cryptocurrencies in emergent markets is fraught with substantial risks, particularly in the areas of regulation and security, despite the potential benefits. The absence of comprehensive regulatory frameworks for digital assets in numerous developing countries has resulted in uncertainty and potential legal ambiguities. Users may be susceptible to fraud, market manipulation, and cyber attacks due to the absence of defined regulations. Scams and phishing attacks may be more prevalent in emerging markets with inadequate regulatory supervision. For instance, the proliferation of fraudulent initial coin offerings, ICOs, and Ponzi schemes has been a source of concern in numerous regions. In order to safeguard users, guarantee market integrity, and confront the distinctive obstacles presented by cryptocurrencies, governments and regulatory bodies must establish robust frameworks. 6. Market risks and volatility. The high volatility of cryptocurrencies is a well-known risk that businesses and individuals in emerging markets must be aware of. Investors and consumers may incur losses as a consequence of the substantial fluctuations in the value of digital assets. This volatility can exacerbate financial instability and present obstacles for individuals who depend on cryptocurrencies for daily transactions or savings in regions with unstable economies. The value of cryptocurrencies can experience a considerable decline during market downturns, which can have a significant impact on the wealth of individuals who have invested a significant portion of their assets. For instance, the volatility of Bitcoin and other significant cryptocurrencies can lead to significant value declines, which can impact both institutional and retail investors. Careful planning and risk management strategies are necessary to mitigate the potential impact of this volatility on businesses and users. 7. Effect on conventional financial systems. Conventional financial systems are on the brink of a significant transformation as a result of the proliferation of cryptocurrencies in emerging markets. New dynamics that challenge the status quo of banking and financial services are introduced as digital currencies acquire traction. In an environment that is becoming increasingly digital, traditional financial institutions may need to adapt rapidly in order to remain competitive and pertinent. Some financial institutions and banks are investigating the possibility of collaborating with crypto platforms and creating their own digital asset solutions in response to the increasing prevalence of cryptocurrencies. This integration has the potential to promote innovation and increase competition, which could lead to a wider range of financial services that are both affordable and diverse for consumers. For example, consumers may experience advantages from improved accessibility to financial products and services that were previously unavailable. Nevertheless, the integration of cryptocurrencies into conventional financial systems is a complex process. Financial institutions and regulators are required to comply with existing laws, mitigate cybersecurity risks, and navigate intricate regulatory environments. In order to mitigate the distinctive risks associated with digital assets, the integration process necessitates meticulous planning and a robust infrastructure. In order to guarantee the seamless and secure integration of cryptocurrencies into the broader financial ecosystem, the financial sector must strike a balance between innovation and regulation as it adjusts to this new paradigm. In conclusion, the global finance landscape is on the brink of a transformative shift as cryptocurrencies continue to acquire traction in emerging markets. The potential advantages are substantial and cannot be disregarded, encompassing a wide range of advantages including reduced transaction costs and further financial inclusion, as well as innovative economic opportunities. For millions of individuals in developing regions, cryptocurrencies present a promising alternative to conventional financial systems that have frequently failed to accommodate their requirements or have excluded them. A new era of economic empowerment is represented by the capacity to access global markets, protect assets from inflation, and engage in the digital economy. Nevertheless, the voyage is rife with obstacles that necessitate meticulous attention. Robust frameworks and safeguards are imperative due to the volatility of digital currencies, regulatory uncertainties, and the potential for deception. It is imperative that policymakers, financial institutions, and stakeholders work together to establish regulations that strike a balance between security and innovation as emerging markets adopt this digital frontier. Education and awareness will also be essential in ensuring that individuals and businesses can enjoy the advantages of cryptocurrencies while minimizing potential risks. The function of cryptocurrency in emerging markets is a dynamic and evolving narrative. These markets have the potential to revolutionize global economic participation by leveraging the opportunities and addressing the inherent challenges. The success of this digital revolution will be contingent upon the ability to achieve a harmonious equilibrium between stability and innovation, thereby establishing a more inclusive and resilient financial future. Let us know in the comments what you think about the role of cryptocurrency in emerging markets, opportunities and risks, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.